Welcome to Financial Statement Analysis Lecture 11 Part D. This is finishing up our lecture and we're going to discuss private equity valuation and mergers and acquisition valuation. Valuation of private firms presents a few tricky challenges for us. What we've done so far is learn how to value publicly listed companies where we can access their financial statements easily. The financial statements have to be audited, released to the public at a certain date, and a lot of things are very transparent about their disclosure policies. However, private firms don't have to obey the same set of rules. So valuing private firms is much more tricky because getting information about those firms is therefore very tricky as well. A lot of people invest their money in private equity funds that actually go and invest in private firms. And in those situations, they have to go and work with the private firms to get the information and think about how much they would be willing to invest in those companies. So if you wanted to invest in Facebook 15 years ago, there'd be private equity firms who go and work with Facebook, get all the information and invest a lot of money and help try and grow Facebook as a company. So the valuation challenges that they face is information's much more difficult. They have to actually work with the managers of the firm to get that information. And then if they do invest in those companies, they often have a real mentorship role in actually trying to grow the companies and make sure they are successful in the future. Obviously, the TV show Shark Tank is an example of thinking about small private firms that you may be willing to invest in at an early stage based on the idea, providing mentorship and some money to hopefully grow it into a large successful business in the future. When we're valuing private firms that are often small growth firms, forecasting becomes a huge challenge. We learned about the discounted cash flow model. If you're trying to forecast many years, all the investments you're making this year are treated as loss of value. So you have to forecast many years into the future until those current investments actually generate positive free cash flows. Valuing private firms therefore becomes more of a challenge, especially when they're small growth firms. If we use price multiples, is it fair to compare to public companies that have different financing structures? If we use the discounted cash flow model, are we actually going to be able to forecast enough years into the future to actually forecast when those cash flows become possible? Are we going to have enough information about the company? Because there's no active market, we can't check our share price estimates to compare against. So there's a lot less information in valuing private firms. There's a methodology called the capitalization of maintainable earnings. It's very similar to what we've done, a bit of a different name and slightly different approach. So the capitalization of maintainable earnings says that to get the equity value of a company, you need to get their future maintainable earnings and multiply it by some sort of earnings multiple. So we need to do some forecasting for the company. We need to be able to think about, okay, maybe many years into the future, what sort of steady state will their earnings be at? Okay, so what would they be able to maintain as their earnings, even if it's many years into the future? So we have to do some sort of forecasting there for their potential profits in the future. Then we still multiply by some sort of earnings multiple, like a PE ratio, their maintainable earnings times their earnings multiple. And the multiple will be linked to their cost of capital more explicitly. So to come up with the maintainable earnings, we can't just use this year's earnings. We need to think about the growth of earnings, if there's going to be accounting distortions or one-off items. Coming up with that number, again, it's a highly volatile estimate or forecast that we have to make. Then when we multiply by the earnings multiple, we need to take into account the cost of capital, so the risk of the firm. And we can think about it this way. A multiple of 2 implies a cost of capital of 50%. So 1 over 2 is 50. A multiple of 5 implies a cost of capital of 20%. 1 over 5 is equal to 20%. So you figure out what earnings you think your company will be able to maintain. Then you think about the risk level of the company and what their cost of capital should be. And you multiply by 1 over their cost of capital. So we're investing in a young company. We think they're very risky. We want a return on our money of 20% to actually invest in this company. So we multiply their maintainable earnings by 5 to get the valuation that we'd actually be willing to pay for that company. This question is similar to the question that we had in tutorial 10 for FSA this semester. We used the abnormal earnings model in the tutorial to get the share price. If we used the capitalization of maintainable earnings, we would end up with the same share price estimation. So the valuation models are similar, they're equivalent. The earnings multiple, if we think the cost of capital is 10%, would use an earnings multiple of 10. And in this question, the maintainable earnings was our owner's equity times our return on equity, or $2.34 per share per year as our maintainable earnings. We multiply that by 10 because our cost of capital is 10%. That gives us a share price based on the capitalization of maintainable earnings. Doesn't require as full level forecasts as the abnormal earnings model, but there's still a lot of estimation error involved in this. This model obviously includes many assumptions that may not turn out to be realistic. It's assuming that all the earnings are actually distributed as cash flow to investors, and that after we reach this maintainable earnings, there's going to be no growth in that earnings. Or if we think there is growth, then maybe we could expect a different price multiple to be used. So that concludes our discussion of private equity valuation. Private equity is a large and growing investment market. Everyone is feeling like they've got FOMO from missing out on investing in companies like Uber and Facebook and all the tech billionaire companies. If you want to invest in the next big thing, you need to invest in private equity funds that are out there looking for them and investing in these young companies and trying to grow them big. When they're making these investments, they have to use valuation models similar to what we've learned, but they face challenges based on the lack of accounting information and the difficulties in making long-term forecasts. So they have different ways, such as maintainable earnings method, that they could utilize for these valuations. We're now going to talk about mergers and acquisitions. Another area where valuation is really important is mergers and acquisitions. So a merger is when two companies decide to join up together and become one company. An acquisition is when one company decides it's going to buy another company and it buys the shares in the company, gains control, and then they become one company. So the term mergers or acquisitions are often used interchangeably. Technically, a merger should be where both companies are happy to do it. An acquisition may occur when only one company is necessarily happy with this deal going through. So mergers are very common. They happen every year in the large developed markets. Big companies are always buying other big companies, and they can occur for a variety of reasons. Most of the reasons should be about making the firm a more competitive firm in their product markets. Financial statement analysis is used again to evaluate which companies should merge together, what are the benefits of these mergers, and what price you should pay when you're thinking about buying another company. So if you're interested in working for one of the big investment banks and get paid the big dollars, mergers and acquisitions is the big money spinner in this area. Investment bankers are in charge of pitching these deals to businesses to encourage them to merge and do all the valuation work and getting the deals done. So there's a lot of money in it, and it's heavily involved in being able to understand the financial statements of both firms, valuing the target firm, and convincing the acquiring firm how much they should pay for this takeover. There's a whole range of reasons why firms may engage in mergers and acquisitions, from economies of scale. If we've got two medium-sized businesses merge, we become a bigger business. Hopefully we can then decrease our cost of production through economies of scale. We can have things like synergy from merging together. Something as simple as we've got two businesses that both have an accounts payable department. We've both got 10 staff in our accounts payable department. When we merge together, we can have one accounts payable department, and maybe we only need 15 staff members to do that job. So we can save on 5 people's salaries. The same for marketing and all the different administrative functions in the business. As we combine them together, we might not need all the different staff. The IT systems, similar story. Bigger IT systems, the fixed cost is spread across more users, so it lowers the overall costs. We could have a situation where we believe one company is not being managed very well. So if we go and take over their assets, we'll be able to use them more efficiently. So we could improve the target firm's management. So that could be a good reason to have a merger or acquisition. We could provide low-cost financing. If one company has a low cost of capital relative to the others, if they're able to go and buy another company and then use their lower cost of capital, that will unlock value for shareholders as well. So there's a whole range of reasons why mergers may be proposed. They're not always for the best reasons. Often it's because managers want to grow their empire, grow their business, make their job more important, and be in charge of a larger organization. Often mergers and acquisitions don't actually result in increases in value for shareholders. So if we're going to value a deal, we're working as an investment banker, one of the things that we need to change about our valuation model is we need to be able to value the synergy of the deal. So as I just discussed, as two companies join together, there may be synergies involved. It could be as simple as removing some of the duplicate roles of staff. So as we combine our two businesses together, what cost savings can we have? As we combine our two businesses together, what sort of economies of scale will we have? All these different savings need to be implemented into the valuation model. So if we can save $1 million a year on staff, we can calculate that as a perpetuity, which would be added to our value in addition to what a retail investor would pay for the company. So if I, Matthew, I'm going to buy shares in a company, I value the company as we've done in this subject. But if Matthew's company is going to buy another company, I value the shares as we've done in this subject, but I also need to value the cost savings and the synergies as an additional step in the valuation model. In Australia, generally when one company is going to buy out another company, to get the deal through, they normally pay on average about 25 to 30% above the current share price just to convince shareholders it's a good deal. So that's called the premium they pay. So often the premium paid around this 25 to 30% higher than the current share price means that for the deal to be beneficial for the acquiring firm, they have to have a lot of synergy that they can unlock from the deal. And often it doesn't turn out to be that case. A lot of deals don't end up making a lot of money for the acquiring firm, but usually very good for the target firm. If Gale Pacific are trading today at 15 cents a share and another business decides to come and buy their shares, they would have to at least pay probably 20 cents a share. So if I'm a shareholder and I own the shares at 15 cents and the takeover comes through and someone's willing to pay 20 cents, suddenly I've made a very handsome return in a single day. So for the target firm, the share price has to be much higher to convince them to sell. They normally do very well. The acquiring firm often ends up overpaying in these situations. Then there's lots of different issues that you need to consider in the merger, from the culture of the firms. Are they likely to work well together? Is the firm that's getting taken over going to be hostile to the deal and try and sabotage it, or are they friendly and keen to go through with it? Mergers and acquisitions have to be financed. If I'm going to spend billions of dollars to buy another company, we need to think about how am I actually going to buy those shares? Am I going to pay cash to existing shareholders, or am I going to use my shares to issue them? Am I going to have to go to the bank and get a loan to finance a deal? The financing is very important to get right in a merger and acquisition, and how the deal is actually financed often influences its success. Target shareholders often prefer cash payments rather than being given stock in the new company. This dot point is often more relevant to the US than Australia, but when a target or a merger and acquisition gets proposed, the target firms sometimes in the US have these really complicated structures set up which kind of prevents hostile takeovers from occurring. They have things called poison pills and staggered boards, all these corporate actions that they can take that makes it much harder for another firm to come and buy all their shares and replace the board of directors. Much less common in Australia, but in America, companies will do things to try and entrench the board of directors. If you're a CEO getting paid millions of dollars, you don't want someone else to come and take over your firm and sack you, because then you're going to lose your salary. If they're going to come and take you over and you're going to agree to it, you're going to have some strong bargaining power to either keep your job or get some sort of parachute payment and a big deal to get paid out of it. So if the deal is actually likely to be completed is something that needs to be analysed from the investment bankers when they're looking at mergers and acquisitions. Are there going to be problems that crop up in analysing the deal? In Australia, the Australian Competition and Consumer Commission, the ACCC, will look at deals and they'll regularly block deals if they think two companies combining together will lead to monopoly pricing power. So if Coles and Woolworths decided they were going to engage in a merger, the ACCC would say no way. That would give too much pricing power over consumers, and the average Australian would be worse off with that deal. However, if IGA and another small company like maybe the Reject Shop were willing to merge, the ACCC would probably say that's okay, because that would increase competition and allow another company to compete better with Woolworths and Coles. Okay, so regulation also influences which deals get through. So that concludes our new knowledge in the financial statement analysis subject. We've now covered the steps in valuing a company from start to finish, with a few little tack-ons today of if you wanted to value a private company or if you were valuing a company for a merger or acquisition deal. In this lecture, we've also talked about if you actually want to go and invest in the market, what sort of lessons you need to learn. You've learned that active managers often promise a lot, but generally their performance doesn't seem to be better on average than passive management, and that Although we can go through and apply these valuation models, it's very difficult to be successful in the long run because the markets are generally reasonably efficient, and using public information to try and outperform the market turns out to be a very difficult concept. I hope you've enjoyed learning how to value a company. Next week, we're going to be doing some revision and talking about the final exam. Thank you very much, and I'll see you next week.